Welcome back, traders. In today's video, I'm showing you a precision gold scalping model built for fast and high probability execution with no guessing, no random entries, just a clear step-by-step framework to sharpen your timing and capture high risk to reward trades. So before we begin, the first thing that we need to understand is institutional timing, also known as kill zones, and why they matter when trading gold. A kill zone is a specific window during the trading day when the market is the most active, institutions, banks, and large players are actively deploying capital. During these windows, price action is intentional. You often see manipulation, stop hunts, and false moves designed to trap traders, followed by expansion within the true direction. In simple terms, this is when smart money makes its move. Now, there's three major sessions within a trading day: Asia, London, and New York. Each one of them has its own individual kill zone. Now, these kill zones have different characteristics depending on which asset you trade. For gold, the Asia session kill zone will typically build the liquidity for the day, and recently it's also had some sharp expansions. Now, that time is from 8 p.m. until midnight. London, this is simply something I do not typically trade for gold, so we're going to pass this, but that is from 2 a.m. until 5 a.m. And the one that we're going to focus on is the New York kill zone from 8 a.m. until 11 a.m. Now, the New York kill zone just has typically the best expansions on the day, and for gold, this will be our primary focus, as this window for gold is the most consistent. It delivers strong, clean, and directional moves, but you can feel free to trade whichever kill zone that fits your own personality and your own asset class. So now we're trading in high probability conditions. How do we know which way to trade? And for that, we're going to move on to step one. So we're going to establish a higher time frame narrative on the daily time frame that dictates if we are bullish on the week, looking for longs, or bearish on the week, looking for shorts. Now, to identify and dictate if we're bullish or bearish, we're going to analyze the Monday candle profile. So here is the rule. If Monday closes bearish, we're going to look for Tuesday to go bullish and the remainder of the week to be in a bullish program. If Monday closes bullish, well, then we're going to look for Tuesday to go bearish and the remainder of the week to be in a bearish program. Now, why does this work? Well, Mondays tend to be the day that creates the liquidity that gets reversed and delivered through on the remainder of the week, also known as establishing the weekly low or the weekly high, which gives us a probability edge on if we're bullish on the week or bearish on the week. But remember, this is not certainty, and bias does not mean we cannot trade in the opposite direction. This model works in both continuation and reversal conditions, but your bias tells us where the highest probability lies. Now, for the next step, once our bias has been established, we're going to move on down to the 15-minute time frame, and we're going to identify premium and discount on the range. So to find this, it's going to be broken into a few steps. The first one is we want to identify impulsive moves. Now, an impulse is simply a displacement with two candles or more that leaves behind bullish or bearish imbalances. On the left-hand side, we have a bullish displacement where the market is making a new higher high, but not only is it a higher high, it's an impulse, right? It left multiple inefficiencies within the leg, clearly showing us we have bullish momentum. On the right-hand side, a bearish impulse is the inverse. We want to see price clearly displace to the downside with two candles or more that in the swing low moving down has left behind inefficiencies, also known as bearish fair value gaps. Once we've identified a bullish or bearish impulse, our next objective is to decipher where is the premium and where is the discount. Now, to find this, you're going to go to TradingView and you're going to use the Fibonacci tool. You're going to draw the Fibonacci tool from the structural swing low to the current price, or the swing high to the current price. And in the settings, you want to remove every single fib level and you want to add the 50%. Now the 50% will be the discount and premium level. In a bullish sense, anywhere that's in the lower half of the 50% is perceived to be cheap, and we want to buy where it's low and sell when it's high. In a bearish sense, we're looking for price to enter a premium because prices are perceived to be expensive on the range, and we want to sell when it's high and buy back in when it's lower to profit the difference. Very straightforward and a very, very useful tool to deciphering a discount and premium on the range. But remember, if we're bullish, we're looking for discount. If we're bearish, we're looking for premium. Now, the final step is we're going to add one more incredibly useful tool. We're going to go and add the fixed range volume profile. So in TradingView.com, the fixed range volume profile is just underneath your Fibonacci. And the way we're going to draw this is the exact same. So from swing low to current price or swing high to current price. And this tool is incredibly powerful. The way that we're going to be using this today is by identifying point of control. So for those that don't know, the fixed range volume profile is broken into three things, or technically four. We have the volume chart, which is the green section. This is not something we're going to be focused on. We have the red line, that's your point of control. The point of control shows us where the most action was traded around. Then we have the two white lines. You have the upper white line and the lower white line. The lower one is your value area low, also known as discount. And the value area high is your upper white line, also known as premium. Now, once we've applied everything to the chart, our next and final step is simply just to remove the volume profile, and we're only going to add it back once price has pulled into the discount or premium range. So this is how your charts are going to look on the 15-minute time frame. Now for step 3, this is where it gets a lot more exciting. We're going to drop down to the 1 minute, and this is going to be your execution models window. Now this will give us the most precise entries into a bullish program or a bearish program. Now in this example, we are bullish because the daily time frame closed bearish on Monday, meaning Tuesday is very probable to go bullish. Now, understanding that, we have then identified a 15-minute impulse, drawn the discounted level, and all we need to do now is wait for price to pull back into a discount. Now, if we were bearish, we'd be waiting for price to pull back into a premium, but in this example, we are bullish. So, fast forwards, now price has pulled back into our discounted level. We're now going to re-add the volume profile. And here, we're just going to drop down to the 1 minute time frame. Now, on the 1 minute, this is where everything's going to come together and really refine and get some high precision entries. But you must make sure you listen. It is simple, but if you miscalculate one step, the whole system will be flawed. So, on the 1 minute, our main focus is now back to the volume profile and more importantly, the red line. Now, that red line is our point of control. If price is below the red line, sellers are dominant. If price is above the red line, well then buyers are dominant. So I do hope you're following along, because if price is currently bearish and we're below the POC, but the higher time frame's bullish, then simply an entry trigger is seeing price close above the red line. That would give us a bullish entry and into the bullish volatility. Now, if we were bearish, I'd be looking for the inverse, and we will go over some real chart examples. Price is bearish. We've pulled back to the 50% level, reaching a premium level. Price is currently above the POC. You'd wait for price to close beneath it. That would be your entry trigger into the bearish market. Now, this gives us actual confirmation without trying to guess, trying to predict, and we're just reacting to order flow shifting in real time. And now, price has closed back above the point of control, successfully shifting the order flow dominance from bearish to bullish, and we're going to use that as our entry trigger. So, take the instant execution on the bullish candle closure. Stop loss, you have a few variants. Value area low, current candle swing low, current swing low, high time frame swing low, etc. I want you guys to really refine this model and refine your edge. Targets, always target the value area high first and at least go risk-free. Then you're going to target the Fibonacci high. Okay, that is going to be your first two major take profits. Then you can use extensions, previous day highs, etc. Get creative with it. This is how it's played out. A really successful position. In terms of our multiple, this would have made you around 3.7. So for every 1,000 you risk, you'd be making 3,700 back. Now, before we go ahead and break down some real life chart examples, go ahead and subscribe to the channel if you have found value up until now. It really helps support me and keep making more content like this. So here we're looking at gold on the daily time frame. I am just analyzing the Monday candle closure, which I can see was bullish. So coming into this week, I'm going to frame a bearish reversal model and I'm going to look for bearish trades. Now, understanding that we're bearish, we now need to go to New York Kill Zone Open. So here we are on the New York Kill Zone Open. Price is at the 8 a.m. window and it's the 12th of February 2026. Now, the first thing we need to do is identify an impulse. I can clearly see that price is range bound as of now. So what we're going to do is draw a box around the range here. And we're simply going to wait for price to break the high or break the low. So retesting the high. And now we've broke the box. So we are impulsing to the downsides. And what we want to do here now is identify, is there any efficiencies? Analyzing the swing low leg, I can see that there is a bearish fair value gap. So to me, that's a good indication of sell side pressure. We now need to identify the discount and premium. So going over here on the left hand side, it's 1, 2 down. Here you're going to find your Fibonacci retracement. You can star this as it's a very useful tool. We're then going to apply it, draw from the swing high to the current price swing low, and then we're going to go find the fixed range volume profile. Now I said it was at the Fibonacci before, but it's actually 2 down where you find your long and short tool. We can see here fixed range volume profile, and now we're going to apply this to the chart. The way I apply it is directly at the Fibonacci high down to the current price. And here you're going to need to open up the indicator settings. So let's double click. Let's go to the bottom here. We're going to press extend right. You're going to make sure that the value area volume says 70. Volume is up down. Row size is 1,000. And then rows layout is number of rows. That is all my settings here. Then you want to go click to apply. And now we've identified some high probability zones. So our next step is to wait for price to pull back into the premium. Okay, the premium is above the green line. Above here is perceived to be expensive and sellers are going to look to short this back to the downside. And of course, you want to make sure you're still in a kill zone. So this candle's at 10 a.m. Kill zone finishes at 11. And by the way, you can take trades outside the kill zone, but it does require a bit more experience. I'm giving you all some concrete rules to have a system that makes money straight away. So let's drop down to the 1 minute. On the 1 minute, our goal is pretty simple here. If we delete this so we can see, and even the sessions, we don't need that. We know we're in New York. This is going to identify what price is currently doing in terms of point of control. Now the point of control, we are above it, so price is bullish, and we're going to wait for that shift in order flow to the downside. Now we're going to keep pressing play because you're going to see something interesting. Our point of control is going to keep moving up and down here, and it looks like we've broken beneath it, but in real time this will stay quite static. This is the bearish signature, then the bullish one's a bit higher. So we can see it's around this region. Let's fast forwards. Okay, fast forwards. We're waiting to see now price break the point of control. Now when I let this play, we can see that it's still here. So we're going to draw a line, and if price can close beneath that line, I'd be interested in taking a short. What's also interesting is price is at the value area high. So we are in a deep premium. We should be dropping to the downside very soon. So candle by candle, we're becoming range bounds. We're breaking the highs again. You've got to be patient here. Again, it looks like we're breaking, but the point control is still at that line. So we just got to keep fast forwarding. And what do we see now? Price is still testing. Okay. So now we have actually shifted. The point of control, because we became range bound here, has shifted and moved higher. So now what has happened? Price has closed a candle closure below the point of control, allowing me to take a short position. Now we have a few variants on stop loss. The most aggressive is the displacement candle. What I actually recommend is the value area high. Okay, that gives you a rough guess if price is going to come back here. You don't want to be in the position anyway, but we're going to use the high R multiple in this example. We're going to place the instant execution, stop loss above the high, and do note we're going to target the swing low as your final TP. It gives around a 7.5 risk to rewards. You'd want to make sure you scale some off at the value area low, and then you can also apply your Fibonacci extensions to really get a high R multiple tool. So you're going to see today, cold really moves to the downside. So it's around a 15 R multiplier. We just press play now. Point and control was broke, and then we hit that final TP. So it's incredibly high, the risk to rewards. Obviously not this high. This is a fantastic example, and you're not going to get these often. That is it for this video. If you want some more examples or me to backtest this model, then please go ahead and join my Discord and recommend me to do so. If you want to, the link will be in the description below. It's completely for free. We've got backtesting sessions coming soon, live streams coming soon, and I look forward to speaking to you all inside the group.